Well, good morning and welcome to your Retirement Playbook. I am your host, Joe Clark. So happy to have you along. Hey, we are talking about the beginning, middle, and end of a financial journey for each and every one of us. And in this segment or this show, we're going to talk about getting your mortgage. We're going to talk about how to save for college for your kids. We're going to talk about gifting during life and when you're gone. And finally, and this is obviously not for you if you're listening, but it's for who's left. They're gone, now what? That's the attempt of the show. Remember, it's broken into 4 different areas, and it is confusing for yours truly, your host, because this is a live thing that goes on to the radio and podcast, wherever you're listening to us, but it's also on our YouTube channel, and so I use the whiteboard to try to make explanations, draw pictures. I am not an artist, attorney, or a CPA, nor do I play one on TV or radio. However, I do have a marker in my hand, and sometimes illustrations help me to think. So if I sound like I'm writing on the board, it is because I'm writing on a board. For those of you who've never been in studio with me, I use no notes. So this is kind of all created based on 35 years of being in the financial world, of helping other families, being a certified financial planner, and teaching it at Purdue University for the number of years. So 7 years, or like I like to say, 14 semesters because it sounds bigger. Talk about bigger. We're going to start this with the first thing that the average Midwest couple does in their livelihood, and that is buy a home. Now, as you've probably seen the data, it is extending longer and longer and longer before people are buying houses. One of my favorite books, or at least favorite titles, is a book I shared with many people. It's called Lies, Damned Lies, and Statistics. You can pretty much make numbers do whatever you want. So when you hear the average age of a person buying a home, understand that in the Midwest, it's still around 27, 28 years old. And on the East and West Coast, it never happens. Real estate's just too expensive. So you average those factors together and the media can pretty much tell whatever story it wants to about mortgages. So I'm going to talk about you, the average American family that we take care of, people who've worked hard, done the heavy lifting, saved and accumulated money, and now you're looking at your kids, and hopefully they're to that age where they're looking at you going, Mom, Dad, what should I consider? And believe me, it does happen. They finally get around to asking those questions, and now you get to provide your insight and guidance. Well, mortgages, depending on when you bought your last home, have changed dramatically. The first thing that you have to pay attention to still is and always will be the understanding of the value of the property that you're buying and how a lender is going to go about financing that and how they're going to decide to give you the mortgage. So that part hasn't changed. There is a 3-letter word, PMI, it stands for Private Mortgage Insurance, that used to be if you didn't have PMI, if you didn't have 20% to put down on a mortgage, you had to pay PMI to the banking institution. And remember, this was insurance for the bank, not for you. So if you defaulted on the mortgage, the loan was taken care of. As we went through the 2000s, that PMI dropped from 20% down to if you had a 10% deposit, you would be okay. And then eventually it actually flat out went away. I started teaching at Purdue in 2008, and by that time there was no PMI. And so when I would tell students when they graduated that they had to have a down payment and to avoid PMI, it was like, Professor, what in the world is that? PMI is back, and you do have to pay it. So you want to have a certain amount of money down, and you want to pay attention to what that PMI charge is. That part really hasn't changed for me and you, nor your kids. I think and one of the things to pay attention to is find out if you're still paying PMI, but you have the right to have your house reappraised. And if the equity in your house is now greater, either based on asset price appreciation or the fact that the value of the outstanding mortgage has declined over a number of years, you can have that PMI removed. In my opinion, it should be automated. Some banks I know do that. Others I hear don't. So you may want to check onto that. So the amount of down payment is critical. How much money do you need to put into the house? Now, here's something that really hasn't changed much over a long extended period of time. When you were younger, buying a home is all about the payment. And when you're older and you're buying a second home or a third home and you've got plenty of money to put down because you've got equity in your first home, it's all about the price that you're paying. So younger tends to be payment. older tends to be price. So where does the payment come from? How is it extrapolated? Well, one, it comes from, do you have to pay PMI? That's based on the down payment. Two, it's what are the terms of the mortgage? And it was interesting to me, somebody very near and dear to my heart. I just got a mortgage, and I asked them what the difference was between the fixed and the variable. And I was told that there wasn't even a conversation. They just gave them the fixed rate. I called the banker or emailed the banker and said, what the heck? And he said, honestly, nobody's talked about variable for so long. We just give people the fixed rate automatically. Folks, you always want to pay attention to those two. So in a fixed mortgage, you're typically going to find a mortgage that is 15 or 30 years. You're going to want to know what the rate is for both of those mortgages and look at the difference, especially if you're on the second end of the spectrum. And remember, this is not about age. Money is rarely a function of age. It is a function of need and ability to get to it when you need to use it. So my mortgage happens to be a 15-year mortgage because when I refinanced it at 2.5% for 15 years, it was almost 2.9 for 30 years. The payment wasn't an issue, so I went with the 2.5%. It may be different if you're younger and you need to make that house payment work, but that was on a fixed. They tend to be 15-year or 30-year mortgages. Again, the longer the time period, the lower the payment, but you're also exposed, if you will, to a period of time before you have it paid off. You can always pay a mortgage ahead of time. I shouldn't say always. Every now and then there's a caveat. Haven't seen one for a long time that says you can't prepay, but most of the time that you can still do that. None of that world has changed. A variable rate tends to be called an ARM, it stands for an adjustable rate mortgage, and it gives you a lock, usually 3, 5, 7, and I've now heard 10 years. I don't even know how you call that a variable. But most of the time they were 3, 5, or 7-year adjustable rate mortgages where your payment was locked for that first period, the 3, the 5, or the 7, and then after that it was a variable rate based on current interest rates at that point in time, plus a certain amount of surcharge. They could say a half a point above prime, for instance, or something of that nature. You used to hear about LIBOR. We don't hear about that a lot anymore. But that's the fixed or adjustable rate. That part hasn't changed. You need to have a down payment to be able to avoid PMI. That hasn't changed. Two big things that have crept up into the world. One is recasting your mortgage. And so understand when you are younger that you can prepay many things in life except for installment notes. It really confuses the bank when you try to prepay car payments. They will accept your money, but it doesn't mean that the payment next month isn't still due. The same is true in a mortgage. My objective was not to have any bills at one point in time. I wanted to be able to pay everybody off for the year. I can send the electric company more money than I owe them. I can send the gas company more money than I owe them. You can do that. You just can't do it with installment notes like mortgages and cars most of the time. Creates a lot of problems. Well, there's been a new thing, never heard of before, called recasting a mortgage, where you have the ability to go out and make a lump sum payment toward your mortgage. Remember, you're not prepaying the payment. So the bank's not going to say if you did that in January that you don't have a bill due in February. What they will do, however, for a fee apparently, is recalculate your future mortgage going forward that would lower your payment. The notes that I found said you have to have a minimum of $5,000 to do it. There's no way in the world I would have them redo your mortgage if you're only putting down $5,000 additional principal and it cost a few $100 to get it done. That makes no sense to me. But if you inherited $100,000 and for some odd reason you thought it made sense, you could put that down on the mortgage and ask for a recast. I don't know if a bank has to comply. It seems to me that this is something that's going across the board, but I would check to find out for sure before you did it. But they will actually go in and reduce the amount of monthly payment. Your terms stay the same in terms of the number of years that are left on your loan, as well as the rate that you're paying. Now, if the payment's not a problem, And if you inherited the $100,000 and you were going to put it down, you can still put it down regardless of what the bank says. You're going to pay less interest. You're just going to pay the mortgage off sooner. So instead of that taking money off the front end of the loan, it actually takes payments off the rear end of the loan, but it does save you a lot of interest. Here's the odd one to me, and I've watched this happen in our neighborhood here in central Indiana. Barb and I live in Anderson, and in my neighborhood, I've watched it happen where people had a price for a home, and somebody came in and made an offer that was essentially 20% more than the price of the house. So everybody's excited. The people buying the house were happy. The people selling the house were really happy. They got 20%. 6 weeks went by and the for sale sign's back in the yard. And I go, what gives? And the answer was the bank didn't appraise the house high enough, and regardless of what you were willing to pay as a buyer or you were willing to accept as a seller, if the bank didn't appraise, they weren't going to loan the money. As a result, house back on the market. Well, to fix that problem, they've now put in a part of the process to where you can have gap insurance, where when you go to buy a house and make an offer, you have to be willing to accept that if the appraisal's $50,000 short, that on top of the down payment required for the bank, you'll come up with the $50,000, so that the seller is not exposed to an appraisal not matching what you're willing to pay for the house. Very interesting times indeed. Darren Hardesty, part of one of the team members on our team, and I am very, very proud to say, passed his certified financial planner boards. He's got to finish his 3 years for right now, but one of the quickest to be able to go through. He's written the article for this, Not Your Father's Mortgage, to discuss a little bit of these points. If you have questions, things that you want to know about, feel free to give us a call at 800-928-4001. You can go on our website at yourlifeafterwork.com. There is a checklist that Darren is going to create that says these are the things you need to be prepared for a mortgage. For instance, we didn't even get to talk about credit scores and some of the issues that are still there that have always been there for those of any age. Again, it's yourlifeafterwork.com. Just go there, click on checklist, and you can get the one for things to consider with a mortgage.